So you have to commit to one direction. That's your bias. Here's the thing. Your bias isn't going to be perfect. And here's a newsflash for you. You as well. I'm not always perfect with my bias either. A bias is just an idea that you want to work within and employ your short sale when you're bearish, or employ your long trade ideas when you're bullish. And you're filtering out the other side of the marketplace. Unless you're proven clearly that you're absolutely wrong, you just simply wait for these setups to form with that bias in mind. Now, I know a lot of you are new and you want to see things taught to you that simply remove any chance of you losing. There is no secret for that here. Nobody's going to teach that to you because it doesn't exist. And frankly, if someone had that, I'll be real honest with you folks. If I had a way that I would never lose, I would have never came out publicly and became a teacher. I would be the richest person you never met. That's the God's honest truth. That's exactly what would happen. And if there's somebody out there that has some kind of a means of never losing, they're doing that very thing. They're never going to talk about it. They're never going to teach it. So you don't need to be perfect. And I've proven imperfection still doubles the account. It's simple. And you can have a lot of losing trades. And this is one of the things that one of my students asked. They said, what if your win rate is really, really low? Can you still double an account? Yes, because I was thumbing my nose at this idea that a risk to reward model is essential for you to be net profitable. That's not true. I've proven that with a live account. I have lots of things I'm going to show you with this TD Ameritrade account before the end of the year. But just know that there are future lessons that I'm going to literally go through and show you, not everything, obviously, because I'm not obligated to show you everything that the other community is entitled to. But I don't need to show you everything to see that account growing. Now, the question is what do you do if you're in a live account? Let's paint a picture for you, okay? Say you're one of those individuals out there that have got caught up in the fever of all these funded account programs, okay? I'm not going to name any in particular because I don't have an affiliation with one. I don't want an affiliation with any of them. And I don't have any personal experience with my own trading with any of them, okay? So that way we know I'm not repping anyone. There's no inside kickback for me, none of that stuff. But there's a number of them out there, and my opinion of them is I have students that have gone through them and they are funded. Do I believe everyone should do that? I don't personally believe everyone should, but it is an avenue that you have to consider on your own. See if you want to do that or not. But let's assume that you've gone through the process and now you have passed whatever that, I guess the challenge or whatever they call it to get funded. And you found yourself with let's say $100,000 account. In other words, you have the ability to trade with what would be considered $100,000. What process, if it were me doing that, okay, I'm going to speak in that perspective. Now, I'm not saying you should do this. Notice what I'm saying here. If it were me and I was starting out all over again, I would use this model and I would go through the process of what I'm going to show you right now. Okay. So bearish daily bias, and I'm going through the daily chart and I'm looking at recent price action. So we had this big drop down here, drawing towards this low. And then the next day we had this candle trade up here. So that creates the fair value gap. So ideally, what we've seen here, we had 1, 2, 3, 4, 5 down days. Now there's likely to have a retracement because we've seen it come way down in terms of the range between this low and this high. So what does that make that area down here? Premium or discount? Discount. So as soon as this fair value gap forms, we know that it's likely to see it rally up into this area here. In other words, a short-term little bounce. That occurring and trading back to this candle's high is enough to set the stage for a new round of selling. So you highlight your area on your daily chart, and then look at what we have in terms of targets. This is an ideal scenario, that low. But it's not likely to do that in one day. Can it do it? Absolutely. But look at what is available in terms of targeting. This day here, it created the fair value gap. So that means we can go in and note that low right there. And we'll change it to blue here. Okay. And we're going to put a little line segment here on this daily candle, and we'll mark that one red. Okay. So we have more or less a premium level that's being highlighted. And you can see it touches it, but it actually goes above it just a little bit. And that's all we'll need to justify a framework. Okay. Now, let me recap real quick. Bearish bias, we're likely to draw down to this low here. Why? Because we had 1, 2, 3 times, like I mentioned on the video on Tuesday, or episode 17, if I'm not mistaken, in this mentorship. So it's likely to draw lower and dig into this low. That's our draw on liquidity on the daily chart. But is that your trade target? No. Not for intraday trading. So you frame your daily highs and lows, previous daily high, previous daily low. So we have this day here, yesterday's trading, or what would be considered Wednesday's trading. And then Thursday's trading, we opened here, we rallied up, popped just above that short-term high. And now because we've seen that, we can target that daily low right here. Okay, so this is the trading day on Thursday. We open, rally up, create a Judas swing, run back into this fair value gap, and then expect it to sell off. And then we can aim for that daily low. Why? Because anybody that went long in here, who would want to do that? There's always buyers and sellers. Okay, so we're going to use previous day's highs and lows like institutional mindset traders do. There's lots of liquidity around daily highs and lows. And high frequency trading algorithms attack previous day's highs and lows. If you were back in the baby pips days when I came on the scene, 2009, 2010, that was the first lesson I started talking about, is highlight the previous day's highs and lows and do that for the last 3 days. If you do that, you'll see a plethora of setups that you can do. And that gives you liquidity pools that you can attack. There's always a fresh supply of new setups. If you're looking at the last 3 days highs and lows, it's always the case. It's always going to be there. You're never going to run out of trades, ever. Okay. So we have our framework here. We have actually, let me change this blue to that green. Okay. So we have premium and discount. So these two levels are represented on the high and low of Wednesday's trading, which would be yesterday's trading. In other words, your chart would have looked like this. Wednesday going into Thursday, before Thursday started trading, you'd have this. So you would mark your chart out like this. So if we go up here and we enter this fair value gap, that's your opportunity to go in looking for shorts. Then if it starts to go down, you're targeting this low with the expectation. Why is it likely to do that? Because it may want to go down to this low, but this gives you a nice range of profitability, potential profitability. So a range of, we'll just call that 935 to a low of, what is it? What's the low here? 74. So 25, 6, we'll call it 60 handles. Okay, not bad. That's a pretty respectable range. Can you get 25 pips out of that? Can you get 30 pips out of that? How about 40 pips? Well, we're going to find out. But this is the range of opportunity that exists looking at Wednesday's trading. And then Thursday we open, we rally up, we bump that high like we would expect, trading back into that fair value gap. And then we watch price. Does it give us a setup? What setup? What I've taught you in this mentorship. So we're going to drop down into the lower time frame. If you have this layout like this, so whatever you do in one chart, it would appear in all the other time frames, which is really nice. This is one of the things that I like to use in TradingView. Not that TradingView is the only platform, because obviously you can do this with everything out there today, but It's just really nice to be able to do this with all my students. They can do the same thing. But if you're working with one screen, like a laptop, and I'll answer this while I'm talking about it. Should you be trading on your phone? No. No, you shouldn't. Can you manage a trade on your phone? Yes. But entering a brand new position on your phone, no. You don't see enough data. It's just too compressed, and you need to be able to see the lay of the land. Okay, you need to be able to open your chart up and really take in the information. If you don't do that, folks, you're really just looking at a small little perspective, really. If you want to have advantages, you do it with a computer screen. Okay, if you want to be handicapped, then obviously try to trade on your phone. Okay. I have not met anyone that has been consistently profitable and trading millions of dollars and they trade on their phone. It doesn't work like that, folks. You got to be responsible. You have to have some real estate. And yes, it requires a little bit of investment, but hey, you don't need all kinds of things. You don't need all the screens like I have and other people have out there. I'm showing you how you can do this with one screen, one monitor. So what would that look like? Obviously, you can see everything I did on the daily chart is transposed onto the hourly chart down here in the lower left-hand corner. And it's transposed over here to the 15-minute time frame. So the time frames are upper left is daily, lower left is hourly, and 15-minute time frame is on the right. The 15-minute time frame is my bellwether chart. That's the one that I go to quickly. I want to keep referencing that 15-minute time frame throughout the day because the information I get from it, which I'm going to show you, is influential to me in terms of managing my position or hunting or stalking a new trade setup. And also it helps me trust my intraday bias. And I'll explain that when we get into that specific time frame. But let me go back for a second to the daily because I want to bring something up. If you're using one screen, okay, you would obviously do this annotation here. And then in this screen, you would just simply change it to the hourly chart. And then everything you did here would be transposed over to the trading view chart. That would be on the hourly chart rather. And then once you've done whatever breakdown and markups that you would have for your hourly chart, then you would drop down to the 15-minute time frame and all of the annotations from the daily and the hourly would appear on your 15-minute chart as you'll see. Okay. So let's go back to the layout, and I'm going to maximize the hourly chart. All right, so I like to do these types of things, bring it to the actual level I'm anchoring to, because I have obsessive compulsive disorder. So it is what it is. It's a struggle, folks. So in here, it's this imbalance on the daily chart, but now we can see it also exists in the hourly as well. So we have what? This high and this high. What are they? They're relative equal highs. Anchored to that point right there. Okay. So usually in my annotations, I'm going into the chart. And this is for the purposes of showing you how to backtest and how you annotate your chart. You toggle it to show on the top left, and you can use whatever color you want. And there you go. So we have the annotations that would be on your chart for logging purposes for your study journal. And then you would just screenshot this. Okay. You might want to zoom in a little bit, make the chart a little bit more aesthetically pleasing. Having something like that, more information zoomed in to a specific area, and then simply go in and start working with the 15-minute time frame, because this is all I would do with the hourly chart, because the frame of reference is that daily fair value gap. We have liquidity pool on the hourly chart. We've already mapped out the 6th of April's low. Notice there's no lower low. This low didn't go down to it. And we start a new day on the 7th here at midnight, New York local time. What do I mean by New York midnight? I'm going to answer that. Let's go to the 15-minute time frame here. And as you can see, we already have that little annotation updated on the 15-minute time frame. So now here's the 15-minute time frame. And I apologize for all of you that would otherwise know how to do this, but obviously it's a mentorship, right? And there's a lot of people in the comment section that are asking for these types of lessons. And once I go through this episode, we won't ever have to revisit it again. Okay, so bear with me, okay? All right, so now we have on the 15-minute time frame, we're going to annotate the daily dividers. All this is a little vertical line, okay? And this little bar here is just my favorites bar, and you can Google that for setting that up. These are the things I use most in TradingView. So when I expand the chart to maximize the full screen, I highlight the little star button in the lower left-hand corner just below the little link button. If you click that link button, any chart you have open that's the same symbol, all the annotations will be plotted and placed on all the time frames of that instrument or that pair or that market. So in other words, if, like I was showing you with my trading layout, upper left-hand corner, daily, hourly, lower left-hand, and 15-minute time frame on the right, it's the biggest chart. Hitting that little link button icon will, again, link all your charts together. So whatever you're showing annotations on one time frame will appear on all of them. That's how this is happening, okay? You can Google that too, and there's a lot of tips you can get off of YouTube for TradingView. Most of my tips I actually got from my students, which I appreciate because they're more fluent with this. I came from MT4 and TradeStation, so I'm a work in progress with TradingView. So you're going to drop a vertical line here to delineate a new day at midnight. What is the opening price at New York? Midnight. That's this candle, and you highlight that, and this price right here, that right there, if you're looking at the time frame on the hourly, that would be the opening price. I'm interested in that on a 15-minute time frame, or if I'm going to be scalping, I'm going to use the 5-minute chart. Okay, and then I'll put 2 reference points on the 5-minute chart. But for the sake of this discussion, just know that that's the actual price I'm looking at, and I'm drawing that out in time. How far am I drawing it out? 11 o'clock in the morning, New York local time. How do I know my chart's going to look like ICTs, right? That's what you're asking. You toggle it to New York. I don't care where you live. I don't care where you're at in all the different time zones. Your TradingView chart needs to be set to this. If you do that, your chart will match all the things I'm teaching, and the things I'm teaching you to look for will be easier to find. Okay, everything will be streamlined in terms of time of day. All right, so now we have the buy-side liquidity pool, the daily delineation of midnight New York time, and we're going to take a little line segment here, and we're going to plot it right on here. Now I'm just going to rough it because it's basically a little tiny indecisive candle. I don't care the difference between the actual open and close. It's very minute, but I'm going to draw that on here. And if you drag your trend line over to the right, if you hold down the shift button, it'll keep your trend line straight. Okay, and just drop it there, and I'll just make this a gray color here. Now you can annotate that, but over time doing it, you'll just know that that's what you're anchoring and showing. This is the opening price at midnight. Okay. Now we have the relative equal highs here. We rallied above them. Once it hits this, do we get displacement? Now we get down to the nitty gritty. Okay. We have a swing low here. It breaks down below that, and then once it does that, does it create an imbalance? Is there a fair value gap? Hint, hint, nudge, nudge. You see that? All right, so we're going to annotate that. So inside of this range here, we have a fair value gap. And I'm going to highlight this. We'll just use this color here. Now, these are probably not the best colors. You're probably cussing me right now, saying, why are you using these ugly colors, ICT? It's mainly just to annoy you so that way you can get more attentive and pay attention, because this is a long video already. So we're looking at the market wanting to go higher first to go lower. And here's that midnight delineation starting a new day. We rally up and then we break down. So what's the model teach? Trading when? The New York session. Okay. So we're trading the New York session. In Forex, it's 7 o'clock in the morning to 10 o'clock in the morning. Right there. Okay. So 10 o'clock in the morning and 7 o'clock. So we're looking for a setup that would be formed within that time frame. Now, you can create killzone windows, annotations on your chart. There's lots of ways I've done this over the years. You can do it whatever way you want to do it. Inside center, and we'll make it black. And there you go. So the New York kill zone, it runs up into that, runs the highs, and we want to see a displacement to the downside. We get it right there. Okay. So now you have this area here, and then you would put your order in right there. What time is that? It's 10 o'clock. So you put your limit order in to sell short right at that price right there, or plus 1 pip, period. And your risk is going to be above this high. The imbalance is really stretched out. You can use that as your stop. If you're really concerned, you can put your stop above the swing high. But whenever you have a big range like that, my stop can place right there. So your stop would be here, and you're going to go short here. That's the minimum expectation using the 15-minute time frame. But we're going to split the 15-minute time frame down into 5-minute intervals. Okay, so we're going to look inside this range here and see if it's advantageous for us to go down into a 5-minute chart. And does it have a fair value gap in that? All right, so we're looking at the 5-minute chart now, and it's that shaded area here. So it's using this specific candle, or that low. And we're looking inside this range right here. Okay, so it's this decline we're looking at. Does it have fair value gap? Well, we have this small one right in here. See that? We have this stretched out one here. Yes. And then we have all this run in here where it has a small little fair value gap. So now think about what's been shown. On that 15-minute time frame, we have a minimum threshold of at least reaching into this low. Okay, remember I showed you on the 15-minute time frame that imbalance. So it needs to get up into that. Okay, so I'm answering the question that I saw, or it really wasn't a question. It was someone trying to make a point that, was I showing something incorrectly by showing a higher time frame fair value gap? Because wouldn't the smaller time frame fair value gap form before the higher time frame? No, it never works like that. The higher time frame imbalances are going to be parent to the subordinate smaller time frames. Okay, the parent, okay, is this 15-minute time frame imbalance. So it needs to get above that. But when it does that, we have to look at the lower time frame below 15-minute time frame, which is the beginning stages of our fine-tuned entry of 5, 4, 3, 2, and 1 time frames. So here we have the 5-minute chart. We have an imbalance right here, and then we have that smaller one right in here, and all the way up to this price point here, we could factor that in, but it's not likely to get up there. So we can look at what? This level here, that is the minimum expectation. You can put a sell limit order there to go short, or you can fine tune this to rebalance all the way up to here, right there. In other words, it would look like this. This would be your imbalance on the 5-minute chart. And if it traded up into that right there, okay, in other words, you could use any specific price in this range here you can pick. This is where the unique style for you comes in. If you get greedy, you may not get your fill. So I'm teaching you the low threshold entry, but that always will give you the highest risk. But that higher risk in terms of number of pips, not in terms of the amount of money, because that part is always controlled by you, the trader. You can manage the amount of leverage you're using. And it doesn't matter how many pips of risk you have. the amount of allocation in terms of the leverage that you're using in the trade, that's the most important thing. And that's the most important thing that gets abused most of the time by traders. Because every time a trader gets in the marketplace, their expectations are, how can I make the most? And they don't necessarily think about the other side of that sword, because if the edge you're trying to chop with, okay, or swing, if it makes contact with your target, then yes, you are profitable. But if it comes back and hits you in the head, okay, you're burying that axe right in your skull. So that leverage is going to be counterproductive to you. It's going to hurt you at that point. It's not going to be beneficial to you. It's going to harm you. So I'm teaching you the low threshold entry, but I'm also teaching you, in addition to that, I'm showing you how to build an additional perspective that helps you find the better entries that allows you to shorten the number of pips or points if you're trading with the index futures. Okay.